Hello, everyone. If my screen works. My name is Kendall. As Maddie said, I've for 3 years now. I implement on TMS and the ERP side with Kyriba and PeopleSoft. I have an expertise in cash management and forecasting, but I have a special expertise in payments with the TMS. So that is what we're going to be talking about today. Little agenda. We're going to go through Lear introductions. Then we're going to get into payment formats and types, ERP to TMS workflow, then into reconciliation, cash forecasting, and cash position worksheets, in-house banking overview, and at the end, we'll have some time for Q&A. Lear introduction and industry experience. Lear was founded in 2005 based on founding partners' expertise in the Treasury space. Since then, we've supported 250 Treasury workstation implementations and advisory projects. Our goal is to be a trusted advisor to our clients, supporting the people, processes, and systems that make their business successful. While we got our start in Treasury, Lear has since expanded to 6 key centers of excellence: Oracle Cloud Services, PeopleSoft Services, Treasury Advisory Services, Managed Services, and newly EPM and Analytics with our acquisition of Stratalized Solutions. These are a little bit more in depth of our Treasury practices: Oracle Cloud Cash Management, FIS, Kyriba, Treasury Advisory Services, on-prem Treasury Workstation Services, and Managed Services. Here is a sampling of our valued clients. We're very proud of the work we have done to earn these clients' trust and continued business. Now let's get into the fun stuff. Payment formats. What is a payment format? A payment format specifies how payment data should be organized and presented to ensure accurate and efficient processing by banks, financial institutions, and payment systems. What is the payment type? The payment type refers to various options clients have for settling bills when acquiring a product or service. Now, why is the payment format critical? Because it is critical for direct connectivity to each bank to automate payments and receive reporting that relies on the payment format. For types, there's 8 methods of ways to perform a payment: credit and debit card, ACH, cash, checks, e-checks, digital, and money orders. The challenge in this: each bank, system, format, and method has their own complex formatting needs. Using a TMS can help streamline the process for domestic and global payments. The extensive build-out of each payment format for each type of payment sent to each bank can take up to 8 months for a single bank to implement. The TMS can streamline not only the building of the payment files, but testing of the payment files with the bank communications and integrations. On cloud-based TMSs, feedback, implement changes, and retest multiple payment formats is exponentially faster than doing it by hand without a TMS. A real-world example is a client I'm currently working on. The client I implemented now has 34 payment banks with multiple payment types per bank. They have 2 separate ERP systems that the payment information is feeding from. I reviewed their payment requirements and streamlined their process. They went from creating 60+ payment file formats to a single integratable format for all banks and payment types. We took their 2 ERP systems, integrated it with our TMS, which is Kyriba, formatting everything so that they just simply had to process through Kyriba, mapped the payment files, and onto the banks. Some of their payments pass through from the ERP to the TMS, and some are generated from the TMS. This means a variety of reporting is also needed alongside the configuration of accounts, banks, connectivity setup, and templated processes. How did I do this? This is done through the flexibility and value of having a TMS do the heavy lifting in the formatting. Heavy lifting is all about the payment output conversion, which happens in the TMS, and all payments are executed the same way in the ERP. So the customer does not see a difference. It just goes through Kyriba so that the formatting goes to the bank in proper form. Moreover, I worked with the banks to streamline the format at the banks so they can provide real-time acknowledgements for up-to-date payment statuses, which our client never had before. On top of that, the payment statuses are not only integrated into the TMS, but also into the 2 ERPs respectively, updating the payment status for real-time visibility. So all updates happening in the two ERPs and the TMS all at the same time. Had we not done this, the client would have had to manually create each format and or continue using each bank portal. There's 34 banks, remember, to generate payments individually, utilizing more resources to complete the same amount the TMS can do in seconds. They also would have to utilize the reporting from the bank to conceptualize all aspects of their treasury management and the delivered reporting in their ERP, where the TMS system can analyze data and give reporting drilled down into their treasury analytics. TMS treasury optimization. The first thing within the treasury optimization in a TMS is routing for bulk payments. Now, what is that? This is when you have the payment format already generated from the ERP in the format the bank is expecting. You can utilize the TMS as a connectivity as a service to route the files to the bank, collecting the data still for your cash position worksheet. Number 2, smart route payments to preferred banks. This is all-inclusive with in-house banking. Based on your bank relationships, the TMS can route payments to the bank that offers the best rate for a foreign exchange payment. If you have a few subsidiaries and you need to make a payment from GBP to a USD third party, you can use your in-house bank to pull the funds from GBP to the USD subsidiary and have the USD subsidiary bank transfer the funds to the third party needing the funds in USD. This saves costs on exchange rate and your transfer fees because it's in-house banking, which we'll get into in a second. The third one is cross-border payment services. Wherever you need to send payments, a TMS provides you with the tools needed, including adding for further credit, also known as FFC, which is sending the funds on behalf of someone. Cross-border payments can also send payments to countries that do not accept payments in the currency of the debiting account and utilize the corresponding or intermediary bank feature to transfer the funds. Next is end-to-end payment tracking. Real-time payment tracking from the time you initiate the payment from the ERP to the TMS to the bank. Payments sent to the bank and payments received by the bank also receive a first level acknowledgement file, meaning that the format was accepted. You then receive a second level acknowledgement file for each transaction in the file being accepted. Your third level acknowledgement file, depending on the payment, you will either see a Fed ref wire or some come through with non-Fed payments and their process, and it shows that they were processed in the back office through the status, which I'll show you in a second as well. Last but not least, there is one payment dashboard. Real-time visualization. This gives real-time visualization analytics of who is generating the payments, which region, and for how much, payment volume per month. You can receive push notification alerts through email upon payment acceptance or rejection for error mitigation. All customizable. This is my favorite example. This is the process in which it could be which could be multiplied when doing the payment format testing without a TMS for just one payment format. As you can see, this is over the course of 6 months. Oftentimes it leans towards 8 months because there's holidays, banks let things slip through the cracks. The intervention of developers is also needed, where a cloud-based TMS, such as Kyriba, uses alias codes to create the payment file with the implemented code. Each bank can take up to 2 weeks to process just one file, leaving testing to fall through the cracks. Manual processes increase the risk of errors, creating greater inefficiencies. The automation of a TMS to build out the bank preferred language of each file format, alongside the complexity of managing the proper bank accounts and templates, enhances the accuracy and control even in the testing phases, being a cost-efficient ROI in the end. This is an overview of one of Alir's TMSs that we implement, Kyriba, as I stated. With many of our clients, we utilize APIs to interface with ERPs of all kinds, satisfying the customer's needs and desires. Each piece of this visual is instantaneous and without manual intervention or a banking portal per bank. First and foremost is the format transformation, as we talked about before. AP users, the benefits here are that AP users never have to leave the ERP. The ERP payment may be initiated and the TMS will transform that same file to the bank-specific formatting language. And with that, there are 50,000 format variations that you could need, and Kyriba can do all of them. Next is bank connectivity. The benefits here are that it is pre-built and it has a tested connector with 24/7 support. And there are various connections that are able to transmit the communications and files to and from the bank to your ERP and TMS as well. Next is standardized payment controls. The benefits here go along with approvals, digital signatures, single sign-on, audit trails, and payment approval workflow for tiered payment limits. That is a large customization that all clients use. Last but not least is payment governance. The benefits here are fraud detection. We have a great seminar on this by Abdel. Sanctions list screening, bank account verifications, and digital policy compliance. Next up is our poll question. How many payment types does your organization accept or process?
So we have responses ranging from 1 to 5. We have few payment formats, 5 to 10, moderate, or 11 plus for high volume. Give people about 15 more seconds to get their answers into the poll. But looks like we have about a 64% participation rate. So most people are saying they have 1 to 5 few formats, with that being 46% of poll respondents. And then it's pretty split between moderate and high volume, then 24% for moderate and 28% for high volume. 11
Okay,
plus.
awesome. For those of you that voted 1 to 5 few types, a benefit of a TMS can be that you have a high volume of payments in recurring formats. With a TMS, you can batch more payments, cutting costs for payment files sent to the bank. If you voted moderate, which is 5 to 10 payment formats, the TMS can be useful to do the heavy lifting for payment logic to the banks. And 11 plus, you have a high volume of payment formats, which also can indicate that you have a high level of or high volume of payments in general. The TMS would be highly useful for a seamless execution of various bank logic translations and template utilizations, which are efficient in recurring payments. Awesome. Now we are going, my screen doesn't like me. Now we are going to get into the ERP to TMS workflow, my favorite one. The TMS systems at Alere all connect to ERP applications through API technology. API is the bridge from the ERP to the TMS with heightened security, scalability, and flexibility. Now, what is an API? API stands for Application Program Interface, and it is a connection between two applications. API connections between an ERP system and a Treasury Management System facilitate seamless data exchange, enabling real-time updates on financial transactions and cash positions. This integration allows organizations to automate workflows such as payment approvals and reconciliations, reducing manual intervention and enhancing accuracy. One API gateway can connect to over 1,000 banks. This makes one connection from ERP to TMS with all payments aggregated in one place with the respective reporting. There is also the export of data integration from ERP to TMS that happens through the API. This includes cash flows, journal entry exports to the general ledger, non-TMS generated payments to be reported in the cash position worksheet, bank statements, and more. Whether you perform the payments in the TMS or integrate the data, the bank connectivity allows for all inbound reporting in both places for various reconciliation purposes. So no matter where you initiate the payment and where the payment goes to, you can have an API that gives all information to the same respective places. The impact in the centralized financial operations provides a comprehensive view of financial data and transactions, allowing various departments the respective information needed for idle cash decision-making in a shortened time span. This is the ERP to TMS workflow we utilize at Alere to showcase the process in which the API connection happens with each application. Here are the benefits of the API connection within the ERP to TMS workflow. First and foremost, it has efficient payment processing. Integration automates the payment process, ensuring the payments instructions from the ERP system are securely processed through the TMS, reducing the risk of manual errors and fraud. It unifies the data sources. Integration ensures that the data flows seamlessly between the TMS and ERP systems, reducing discrepancies and improving data accuracy. And last but not least, real-time updates. Synchronization systems provides real-time updates on financial transactions, cash positions, and account balances, ensuring that both systems reflect the latest financial data. Another flow. TMS is all things Treasury, where your payments can be completed or just sent through for cash visibility. Whatever you choose for your ERP and TMS delegations, you do not have to worry about the lack of information in either system with the right connectivity setup. Enhanced data accuracy, efficient use of resources, and regulatory compliance are all benefits in the ERP to TMS workflow. The integration of data allows for seamless payment transfers with respective reporting, leading to greater accuracy and reconciliation and payment strategy optimization. Both systems can be updated to comply with current regulations, ensuring that payment processes remain compliant with legal requirements. Why is this important? For example, if you want to do payments and bank reconciliation in your ERP, you can simply send the payments to the TMS through the API connection solely to have a cash position worksheet created with an aggregate view of cash and complete the cash reconciliation of cash flows in your TMS by having your bank statement come back to your TMS and your ERP through an API connection. The flexibility in a TMS with an ERP allows you to zoom in and drill down in a cash visibility aspect and cash flow reconciliation with forecasted cash movement, while also having the right data in place for end-to-end uniform processes of an ERP. If you're using your ERP to do all payments and you want it to go through the TMS so that you can capture the confirmed forecast, you can also do that. It'll lock in the payments, going straight to the bank afterwards. Payment mapping. What is payment mapping? Payment mapping ensures that payment instructions generated by the TMS are accurately formatted and compliant with the requirements of each bank and payment networks against the various transaction types. It translates payment data from the internal format used by the company, typically in the ERP, into the specific formats needed for execution and reporting by external financial institutions. Structure and transformation rules are also a big part of payment mapping. This is where you first input the data mapping, which is defining how the payment details are extracted from your ERP payment file. Then you go into the format transformation, which specifies the conversion of payment data into various formats required by different banking institutions. Think SWIFT, ISO 20022 XML, NACHA for ACH payments, SEPA for Euro transactions. Then you move into field mapping. This aligns internal fields and data elements with the corresponding fields in the external payment formats. This includes the mapping of account numbers, beneficiary details, and amounts data fields. Number 4 is the customizable templates. This provides the ability to create and customize templates for different payment types and formats. Number 5, bank communication. This maps payment data to the formats required by each bank for each payment method. This is where you get into the payment method types. Number 6 is connectivity. This facilitates seamless integration with various banking platforms, enabling the automation of payment file transmission. Now, why is this important? Without these pre-configured customizations within a TMS, you would have to do this by hand when the ERP does not produce the proper file format for each respective bank, or manually inputting each payment into the banking portal for each bank and every transaction type. Like I said, my client was doing this for 34 different banks. I'm going to show you an example of a file that we integrated from an ERP system, and it was a CSV file format. This is what came from the ERP, because this is what the ERP was spitting out when they were creating their payments, but the bank was asking for an XML version of the same file. What we did here, through the mapping in Kyriba, we created an XML mapping the fields properly and sending this off to the bank for testing and passing. So that's a little bit of what it looks like. CSV turning into an XML. Here is a more in-depth workflow of what happens with an ERP and TMS integration and the bank communications. Whether your organization decides to initiate payment from the ERP and approve them in the TMS or some variation of that, the payments are sent to the bank while also creating the respective cash flows. There is always multifaceted use of the API being able to transmit data reporting both forwards and backwards. Once the bank receives the payment, the BII file comes back through to the ERP and the TMS, or one or the other. The reported transactions then reconcile with the cash flows to make the confirmed forecast actuals. This ensures that the confirmed forecasts are no longer accounted for in the cash position worksheet as they already occurred at the bank, becoming actuals. Any extra information you wish to receive from the TMS to the ERP can be integrated via an SFTP connection or API set up to run automatically daily. Now getting into approvals. Like I said, you can choose to do approvals in your ERP, in the TMS, or a mixture of both. You can initiate payments in the ERP and TMS with separate approval workflows, which allow for various end users to execute their respective payment processing. If you choose approval workflow in ERP, TMS allows you to lock the payment with no modifications allowed for straight through processing. You can have approval workflows at the ERP level and then again at the TMS for extra precautionaries. This capability allows for a tightened security on not only the approvals, but the execution and streamlines the approval workflow for all departments involved. If you choose to do some here and some there, or want the ERP payments routed through to the TMS, the intelligent routing connectivity will be set up on the payment dispatch for all information to be imported to the TMS for cash reconciliation and cash position worksheet creations. Should you never want the ability to transmit payments in the TMS, you only utilize the cash module. TMSs have intelligent routing where the payment is routed through the TMS only to capture the above cash flows, being confirmed forecasts, and send them to the bank with ease. Now we will get into the real-time payments. What are real-time payments? Real-time payments are enabled by modern payment systems that can clear and settle payment instructions within seconds or minutes. These can be performed 24/7, 365 days a year with data-rich information for your records. Think Zelle, instant payments that require no intervention from the banks. You go from your sender to the sender's financial institution, straight to the FedNow service, into the beneficiary's financial institution, into the beneficiary's hands, all within seconds. Real-time payments are effective in over 70 countries, automating transactions and giving the ability to complete wire-like transfers within seconds. Having visibility into real-time payment processing gives you a better understanding of the available working capital, allowing treasurers to make thorough decisions with idle cash. Any rejection will come through in real time as well, allowing errors to be fixed and not defaulting on payments you thought that went through. For example, if you pay rent in real time, but you put in the wrong bank account number, instead of it being 3 days to realize the payment rejected, you now have a late fee on top of paying rent. You can see the rejection payment within minutes with a noted error of what went wrong, knowing exactly what to fix, fixing the error, putting it back through, and paying rent on time. Why is this important? These are the top 4 standardized payment formats, allowing for real-time feedback on the payments executed with delivery acknowledgement files, as well as payment retrieval notifications. So as you can see, these are the 4 types supported: JSON, ISO 20022, fixed formats, and CSV formats. Not only are the notifications useful, but the status update of the payments allows real-time visibility into where the payment is in processing and what the bank's end is seeing to ensure the success of the payment. This also allows for end users to execute payments on their own timing, not constrained by bank hours. Coolest part. The impact of this on corporations and the overall benefits of real-time payments are as such. First and foremost, contingent payments. Dependent on another payment coming through. This is where if you want a payment to go through only if another payment comes through so the money is in your account. This limits overdraft fees and intraday credits should the expected payment not process. Emergency payments. The benefit here is any shortfalls can be fixed in real time without the intervention of banks needed. Payment digitization. The benefit here is reducing manual labor, your carbon footprint, and leave out the onerous check process. With digitization, you get real-time status updates and the money is received within minutes. Last but not least, low cost to pay. The benefit here is that customers can be rest assured they receive the payment with no backlash of ACH or check processing being revoked, the real-time gross settlements of wires without the expense of wire processing. Payment flow of real-time payments. Here's a general flow of the real-time payments. Number one is initiation. The payer initiates instant payment request. If no TMS, you use the banking portal. Number two is authorization. Payment request received, bank verifies that there are sufficient funds in the sender's bank account. Number three, transmission. Payment message transmitted to the beneficiary's bank in real time. Number four, clearing. Beneficiary's bank processes payment message and verifies account details from the payer. Number five, the settlement. The actual transfer of funds from the payer's bank to the beneficiary's account. With every arrow, there will be an acknowledgement of where the payment is at to track the entire flow of the real-time payment. Now getting into reconciliation. Utilizing an ERP or TMS automates reconciliation with increased accuracy due to decreased manual intervention in end-to-end processes. The bank statement comes in through the connectivity, allowing reconciliation with cash flows, which would be cash reconciliation, or TMS and non-TMS generated payments being bank reconciliation. This increases efficiency with instant reporting of any unreconciled transactions that need attention. You can utilize enhancements for data specifications within each financial institution connectivity to allow reconciliation of complex scenarios. This is the manual process of reconciliation that we have clients all over doing spreadsheets, causing months of backup due to the inability to keep up with errors. Variances are also a large part in balances being off and companies losing millions every year due to untracked payments resulting in the poor execution of cash handling. How do we fix this? We keep a close eye on all variances in reconciliation. This is my favorite report. This is the bank variance report that we produce in Kyriba. Lots of TMSs can do this. This breaks down any variances that you will see, breaking down the bank statement balance being the balance reported on the bank statement by the bank ledger balance, which is the TMS calculations of the bank statement balance with the transactions in the bank statement, the flow ledger balance, Kyriba's calculations of all calculations in the cash module, in addition to the opening balance. And then the bottom line is the flow ledger minus the bank ledger. This is where you'll see variances and you want it to always be zero. If it's not zero, you know you have a variance and you can easily drill down to see where that variance is coming from because the reconciliation that did not occur. Benefits of a TMS reconciliation. Less human intervention with more automation, freeing up resources otherwise spent on manual matching of transactions. A lot of our clients are still stuck in the Excel, while Excel is such a great tool to use and all of our systems can be downloaded into Excel. Using a TMS to automatically reconcile streamlines a lot of the process. It's instantaneous, allowing for more focus on investments and debt payments rather than finding solutions for unreconciled transactions. You get quicker month-end closes and improved transparency and money movements, accurate cash positioning and ability to deliver more concise reporting, fraud detection, real-time visibility, and audit trails, facilitating internal and external audits and improving overall transparency. Now getting into cash flows and cash position worksheets. A TMS is a centralization of all data, creating the ability to do more with working capital, investments, and debt payments. The TMS allows for reconciliation of cash flows as well as transactions, so your CPW is automatically updated with bank statement imports. You can set parameters for debt covenants that require companies to have certain cash thresholds in each account, and predictable growth, with cash surpluses planned and executed for proper investment types. Last but not least, your TMS can automate debt payments and can perform automatic cash sweeps for excess cash to be swept in its respective places, like a ZBA account. The TMS supports various cash forecasting timelines to benefit various objectives in each company. Reporting within TMS can be edited in the end user's viewing preferences for the ease of analyzation, creating quicker decision-making backed by data. Whether you utilize the payments module or intelligently route payments through your TMS, all transactions can be input for cash flow forecasting, creating a confirmed forecast to be reconciled against the BAI file that comes in the following day, coming to your TMS and your ERP. With the direct storage of all data in one place, automation of cash position worksheets with increased accuracy makes for less errors in future payments and fund movement. This is what the TMS will look like for a cash position worksheet or a specific drill down in a cash flow. The advantage of this is that it is modular and that you can build your table however you please in order to sort the data for your viewing preferences. The TMS here shows symbols representing confirmed forecast, estimated forecast, actuals, and final balances. You can utilize the drop-down arrow on the left-hand side to see what the transaction type consists of in the account view or whichever category you choose. As you can see, the category chosen here are business units separated by the transaction types, but when you do the drop-down arrow, it separates it by account. This is another look at a CPW separated by accounts, giving color coding characteristics against debits and credits. This is all part of the modular build of a TMS cash position worksheet for your visibility preferences. So as you can see across the top, it goes by account and transaction types on the left-hand side. All customizable at the end user's preference. Okay, so after that, we are going to get into the in-house banking overview. What is it? An in-house bank is a structure within an organization where a specific entity takes on centralized management of treasury functions such as cash management, liquidity, and risk. Inefficient and ineffective use of cash can increase operating costs and limit a treasury team's ability to ensure financial resiliency. With higher rates, external debt costs even more to borrow, and every trapped dollar not put to strategic use represents an opportunity cost in foregone interest income. All organizations have the consideration of adopting an in-house banking's key functionality to realize a positive impact to their working capital and through cash management, investment, and funding enhancements. Within an in-house banking structure, Treasury has clear visibility, access, and control over corporate cash. Without this visibility, Treasury often spends considerable time and expenses to gain visibility over funds across fragmented subsidiaries, often involving multiple countries, currencies, and operational delays. This may result in the organization relying on increasingly expensive external credit when it may not need to. The in-house banking structure simplifies the Treasury infrastructure and allows organizations to readily identify, then consolidate cash from various sources to allocate funds strategically, leveraging the organization's aggregate cash position for the benefit of the whole firm. This is just a little example of a client that uses in-house banking versus a client that doesn't. Client A, if you are not using in-house banking, you are still having to pay the bank fees in order to make that wire, whether it's an internal account or an external account, in order to make that balance out. Domestic wires, client A was using JPMC Bank. The domestic wire was $25. International wire was $40 per wire being sent. If you did it as an ACH, taking a little bit longer to fund the account needed, it's only $2.50 up to 10 and then 15 cents thereafter, but the funds are prolonged. Client B, in-house banking, no excess account fees, $0 transfer fees between internal accounts, and it happens instantaneously. Without in-house banking in a TMS, you would have to spend all funds externally with bank institutional fees per transaction. This not only is not cost effective, but is tedious per bank portal. Alir has two treasury platforms that perform in-house banking, PeopleSoft and Kyriba, but in-house banking all works the same. Number one, all accounts are established with their respective internal banks, connecting parent and child accounts. Number two, activities such as internal transfers for various idle cash, loans, and payment needs are tracked through to your general ledger, showing proof that your internal movements happened and the accounting is automatically created. Number three, statement reports. Acting as an external bank's BAI, they're produced for internal banks and bank accounts to utilize for the reporting purposes of the internal movement of the money. The advantages here, in the in-house banking model, Treasury acts as a single interface for organization with external lenders. By aggregating credit needs, the company can borrow funds strategically from lenders that offer more advantageous terms and conditions. An in-house bank structure often simplifies the administration of intercompany lending positions between subsidiaries, replacing multi-entity lending relationships with bilateral arrangements between the subsidiary and the in-house banking entity. In addition, intercompany transaction flows are often netted, which can significantly reduce transaction settlement charges and banking fees. The benefits here are the intercompany loans, your ability to track and account for structured loan arrangements with flexible principal and interest terms. Number two, interest calculations. Interest rate structures are managed between holding companies and subsidiaries to allow for calculations of interest income or expense of in-house banking positions held. Simplification through centralization. This provides banking services to all business units, i.e., sending one currency in a lump sum to be distributed to all vendors across the globe in their respective currency. Next is multilateral netting, simplifying the payment structures and reduces the payment volume, lowering processing times and overall costs. Last but not least is automatic settlements. Both physical, which would be cash, and non-cash movements can be triggered through in-house banking. In-house banking provides more than just cash transfers. Under the cash sector, it has improved visibility, simplified banking landscape, and increased returns with less idle cash. Under the foreign exchange risk, you can aggregate exposures, net foreign exchange payment to reduce the number of transactions, therefore reducing the cross-border payment fees. Under the payments umbrella, you have greater fraud prevention, less intercompany loans and internal transfers, and reducing bank fees associated with payments and account holding. Last but not least, working capital. You have better support for business units and more opportunity for discounting with better visibility into cash flows. One last poll question. What is your organization's use of in-house banking?
Great, you should see that up on your screen. Possible answers could be, we have one and we're using an in-house bank currently. We don't have an IHB, and then we're looking into getting an IHB, but we don't have one in our organization right now. Give people another 10, 15 seconds to get those answers in. All right, looks like we have about 71% participation in the poll question, so I'll go ahead and close it out. Looks like 54% don't have an IHB. It's pretty split, wow. And then 43% actually have one and are using them currently. 4% are looking into it.
Awesome. So some of this is recurring information. Some of you, it's new to you. We love our in-house banking. All right. Just a few key takeaways from this Painless Payments presentation. Utilizing a TMS is resourceful even with an ERP system already in place for streamlined payments and automations. TMS can significantly increase resource availability, decrease manual intervention, and reduce errors in your reconciliation processes. Cash forecasting with the TMS can decrease idle cash to optimize investments or debt repayments. Last but not least, you can significantly cut costs with the performance of in-house banking within a TMS. Do we have any questions?
It looks like we had one, kind of looking for a really specific answer, so we might need to follow up with this one offline, but
Okay,
what is the average cost per transaction of an RTP? I'm not sure if we had that
I
data
don't have
available
that
to us.
answer, but I will definitely get back to you when I do find that.
Um, Any other questions that attendees have, you can reach out to ete2024@allure.com and we can get those answered. We can delegate those to our SMEs. But right now we can get to our wrap up and our $5 Starbucks gift card winners. We have Julie Boyd, Veronica Harris, Tracy Mock, Joe Thomas, and Hamaz Yulidas. So we will be reaching out at the end of the day with those gift cards via email. Thank you so much to Kendall. Next up, we have our last session block of the day with 2 sessions, working capital, how to leverage your working capital for better decision making, or bank connectivity, trusting your bank connections, and cash flow with current day files and APIs. And those 2 links to join the sessions are available in the chat. Thank you for joining, and another reminder to join us on our social media platforms. Please follow us on our LinkedIn and our YouTube channel and use the hashtag ETE2024 to be entered to win a chance for additional prizes and drawings throughout the event. Thank you again, and we will see you in those next sessions.
Awesome. Thanks, guys.